Good morning, everyone, and welcome to the Creative Birth Strategy podcast and house here on Clubhouse, as well as Apple, Spotify, Audible, YouTube, Facebook, LinkedIn, Twitter, etc. So we're going to get into a deep discussion again this morning. We're here every Saturday morning, 8 a.m., and every Sunday morning, 9:30 a.m. My name is Joseph Scarice. I am your host and founder of this group and podcast. We've been here for several years on Clubhouse, but we've now hit close to 50 episodes with our new relaunched website, creativebirdstrategies.com. So we're here to hopefully provide a consistent theme of education, networking, and strategy. And if anybody would like to come up and say hello, please do so. I'm going to do a quick share to the room and invite some of my connections on Clubhouse to get some people in. And then we'll get into our discussion this morning. Recession versus resilience, real estate strategies, 2024. So we're going to be real quick here, do some little thumb action in inviting some people in. But I'd like to always thank our sponsors. I'd like to start off with thanking Perkatech, Yordell Perkins, our social media strategist, and our partner here at the Creative Birth Strategies podcast. Realty 411 with Linda Pelagas. We also like to thank MB Capital, your unsecured business line of credit referral program for unsecured business lines of credit for investors and business to business as well. And then finally, Lendmark Capital, your nationwide asset-based lender in the investment space, offering rental loans, fixed-to-rent loans, multifamily loans, as well as new construction. And if you have any questions, please feel free to reach out to me for a one-on-one. So, yep, it's Memorial Day weekend. We're going to get started here with a brief discussion on recession versus resilience. I'm going to invite everybody up to see if they'd like to come up. Don't be shy. Don't be shy. Let's see who wants to come up and have a little chat. So I just poked a little bit to see if anybody would like to come up. Not that I don't have a problem being by myself, but I'm a rogue kind of guy anyway. But Melissa, good morning. How are you? Melissa, you there?
Can you hear me?
Yeah.
Can you guys hear me?
Yep.
I'm actually sitting at a campground with a nice little fire, coffee, and my dog sitting next to me this Memorial Day weekend. So.
You want to know what my version of camping would be?
What's that?
A residence inn, and somebody serving me a glass of wine and some cut cheese and some greasy meats. So if you can't tell, that's one of my type of ways of camping. I just never got into the camping thing, not even as a Cub Scout.
Oh yeah, and my husband was a Boy Scout. I don't think he made Eagle.
No,
but,
no.
Hey, let me introduce myself. This is Melissa King, One Last Eye LLC. I'm a virtual assistant, realty, bookkeeping, and admin professional here in West Michigan. I'm here to listen to Joe. And this was a test this morning, Joe, because they did just boost the Wi-Fi here in our favorite campground. We are actually about not even a quarter mile from the Lake Michigan Lakeshore, West Michigan Lakeshore. Okay. And a beautiful morning. So I'm glad everybody can make it today.
Yeah, I appreciate that. Yeah, it's a beautiful day here in southern New Jersey, and what an interesting week. And we'll get into it a little bit here. Rates kind of we're at a kind of tumultuous market right now. The base rate for conventional closed out at 7.16. The commercial rate has been staying pretty steady. And actually, in the multifamily space, Freddie and Fannie on the agency side, some of the rates dropped. My rates kind of stayed very straight and narrow. They didn't go up. They didn't go down. They've been holding fast. Our base rate's still at 7% on 1 through 4 units. On the 5 through 25 units, under 3 million, we're somewhere starting at around 8%. Starting to put a lot of quotes out on that 5 through 10 unit space right now. A lot of them are coming to the front line for refinance or acquisition. I'm seeing more of them in the past several weeks than the last month. But very interesting on the market, watching people how they're evaluating. And then obviously some of the articles that were posted out this month this week were really, interesting to read. I put an article out for rent prices settling in the Sun Belt. So we're starting to see a leveling on the rental environment out in the major migration reports. We're seeing also adaptive conversions, abandoned buildings to luxury housing or even low-income housing on the rise. And that's not going to slow down as we see more commercial buildings stressed with occupancy, and they're not going to have much of a choice if they're not going to be able to be converted. What are you going to do with some of these buildings? Um, Price trending and opportunity zones keep pace with the U.S. markets. Um, Home buying is overburdened and overwhelmed. We're definitely seeing it. We're not really seeing a spring market. You're not seeing realtors out there touting, hey, get to these open houses. It's kind of a quiet, kind of gradual selling point right now. And that's because it's really an investor's market and just nobody wants to admit to it. It's I don't know unless it's out of complete necessity. I'm not seeing home buying push pretty much in any of the urban settings throughout the country, and in the suburban settings, it's really definitely community by community. Okay, so there's a lot of timing there. I'm seeing flippers becoming landlords. I'm seeing property management companies becoming more diversified and much more busier. I see property management companies hiring more. I've been presented an opportunity as another lane in my revenue stream to work with a national property management company with my licenses alongside of working at Landmark and alongside working with MB Capital, alongside with my investments and things of that nature. So it's very interesting. I'm having a meeting with them this week and see how I could leverage my licenses with them and we collaborate. And the worst thing that happens, I get a couple good loans out of it per month with a couple of qualified borrowers. But I am interested with that because management is on the rise. So that's telling me the landlord is on the rise. So I put an article out this week in regards to our discussion this morning, recession versus resilience, real estate strategies 2024. We face a very complex landscape characterized by dual forces of potential recession and economic resilience. Navigating this environment requires a nuanced understanding of the market dynamics and strategic planning. So I broke down some key strategies for key investments in context of recession and resilience. Understanding the economic landscape, understanding the rising interest rates. I was on a quick podcast this morning with a local RIA group, and somebody was telling me, "Oh, I think rates are going to be down at 6% real soon." I'm like, "Where are you getting this information?" Well, I saw it on some kind of advertisement or something. Like, listen, follow the data. You're not going to see six. You got a better chance of seeing 9% than 6% over the next 12 to 24 months. It's just we are in the seventh inning of a reset of a 10 years cycle of real estate. So, higher borrowing costs can dampen real estate demand. Economic slowdown, reduced consumer spending, and corporate investment can impact commercial real estate, which we're seeing with conversions. Job market fluctuations, employment instability can affect residential rental markets as well as home buying resilient factors. Demographic trends, population growth in certain regions can sustain housing demands. Technological advancements, innovations in property technology, prop tech, and glad Amy's here. Maybe she could touch on that in a minute. Can enhance property management and operational efficiency. And government policies, like what are they doing to stimulate measures and infrastructure investments that can bolster real estate sectors? So for us, for strategy wise, we have to be diversified. We got to look at different asset classes, whether it's residential, mixed use, maybe even industrial, specialized properties, maybe data centers or healthcare facilities. Geographical diversification, explore opportunities in emerging markets or regions with strong economic fundamentals and growth potential. That means becoming the out-of-state landlord and building a power team, boots on the ground elsewhere than where you live. Focus on the essentials, residential real estate or something healthcare related might be something of an opportunity. Value-added investments, renovations and redevelopment. I would say if I was an investor today in beginning, I'd look at lighter rehab in and out of a project at 45% of the purchase price. Meaning, if I'm buying something for 100, no more than $45,000 in renovations, turn the property around and restabilize it. Cash flow and liquidity are going to be very important. That's why I'm having deeper discussions with my clients about unsecured business lines of credit. Then there's prop tech adoption, leverage technology for property management, tenant engagement, operational efficiencies, data analytics, utilize data analytics to inform, investment decisions. Okay. So the track market trends. So like Yordell and myself are evaluating advertising for the podcast. We're close to 50, podcasts loaded, ready to go. The website's up, all our social media buckets up. Now we're looking at how to advertise and take advantage of the qualitative content that we're putting out. So these are some thoughts just to start off the room and get things going. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, recession versus resilience, real estate strategies.
Hey, Joe. So good to be with you this morning. I'm glad I was able to pop in the room. I'm Amy Palvido. I am the founder and CEO of Fistula Mac, a data aggregation company. We make real estate investing more predictable. That's our tagline, by using data. I'm also the chairwoman of the U.S. PropTech Council, which is the trade association for the PropTech industry in the United States. And I've been a real estate investor and developer since 2008. So I've been doing this for a while. So it's been awesome. And I probably will always be a real estate developer. I just kind of went over to the dark side and made it over to tech for a little while. But yeah, no. So as far as recession versus resilience, I think, as we get through the continued pressure of the valuations on real estate, right? Because the interest rates, you're totally right. They're not going to, for anybody who said that they're going to lower rates this year, you are smoking something, and I don't know what it is, but I want it. It'd be awesome. Because they're not going to do it. I mean, it's the latest and greatest was, oh yeah, they'll do 3 cuts this year, and then it went to, oh, maybe they won't. Maybe they'll do one. To now, the prevalent thought is that they're not going to cut them at all. And so, but the interest rates staying high or where they're at just forces prices to come down, right? Because people have less buying power, which is a good thing. I think the real estate needs to reevaluate how it operates, which I totally believe in. I think there needs to be a good hard look at how you manage your buildings, which is probably why you're seeing more managers come in. People come in because I think there's a property management crisis in this country. And there are, when real estate is easy, you get lots of property managers that that can pretend. But when real estate is hard, then you have to find you have to weed through the chaff, right? You got to find the really good ones, the really good operators, really good managers. So that's my half a nickel so far, I think.
So, Amy, do you think we're in a recession based on the current? Yeah,
I do. Just based off of the transactional volume, the amount of foreclosures that we're seeing, the amount of vacancy that's in certain asset classes. Yeah, I consider it a recession. It's been longer than a real estate recession, not an overall economic recession, but I know we're in a real estate recession. Just from performance over the last year alone. I mean, you're supposed to be down for 2 quarters. Well, real estate's hit. So, but I would say that probably the continued pressure on real estate valuation prices, just because the interest rates are affecting cap rates. I think that's gonna cause. It's just a quandary, right? Especially in housing, because we still short so many housing units, and so it's just like a tough place to be for sure. It's just a tough spot that we're in.
So if we bring another million or so rentals to the market, to the front line, between the influx of conversions, along with institutional money doing build to rent. Don't you think we might have a surplus at a certain point where it's going to force rental market down? It's going to force values down because there's less home buying, so there's nothing to comp off of, and you're really going to have to do all your evaluations by income production at that point. Whether
yeah. I mean, generally that's the main driver. Correct. I mean, like it's but I mean, you know, the estimates were we were 4 million houses short, right? And we were 4 million units short as of, you know, last year. So even if like, so multifamily comes online at about a pace of about 500,000 units a year in the U.S., right? That's about the max that you're going to get out of. Now, if you're doing build to rent houses and other things, so maybe we get 1 million, but we're still, you know, we can't catch up unless the demand decreases, right? I mean, if we're 4 million housing units short and we're still needing housing year after year, I'm not sure how we catch that until the demand decreases. So I don't know.
I just have I have a bad feeling.
But we can't build anything other than luxury or affordable at the moment because it doesn't pencil.
Yeah, I'm just a little nervous because I'm seeing appraisers contracting values because their complaint is there's nothing to grab onto on sold and settled. So go 12 months further back down the road, there's less buying, and there's more off-market deals being done that the appraiser can't even find. Where are they going to grab onto values to justify your appraisal when you renovate a property and you're trying to look for stabilization money? What happens? You know, what happens to debt service? What happens to, you know, I'm not even worried about cap rate. I'm worried about just income and expense calculations to support what you took out 12 months ago.
Oh, I totally agree with you. I don't know how an appraiser does anything today. There are no comps. There are no, you know, like, but that whole changing how I don't know how you evaluate a property today. Like you know, other than if you're looking at what's for sale. I mean, I guess. I mean, but yeah, no. I get you. It's tough. And then, but the funny thing is that appraisal is so crucial to all of your lending, and you know, and then the lending determines what you're able to get on your return on your investment. And so it's a total it's a quandary for sure.
So in the past 2 weeks, I think, well, this past quarter, well, this month alone, we're closing about 56 of my loans, and for the quarter, I did about 37 million, 38 million, and I'm going to tell you, at least 50% of the appraisals came back soft in some form or fashion, or they designated the finish of the property not completely stabilized, meaning they're really nitpicking on the condition of the unit, even after landlords or rehabbers are rehabbing the properties. They're saying, hey, they're not fully rehabbed, they're missing this or missing that. They're really pinpointing. And I'm also seeing a higher inquiry for mixed use with less availability of lending options, especially in the asset-based lending space. Asset-based lending does not want to touch mixed use at all in my space. They want to stay away from it. There's like one real investor that's touching it, and the rates are, you know, they might as well be, you know, double digit at this point. They're 9.5%, 10%, and the LTV's cut back because I think there's a high concern of vacancy in these smaller commercial landscapes, even definitely in the urban settings, because people are still not back to work. But the suburban settings, I mean, how many nail salons and dispensaries can you fill these units with, right? How much weed can you smoke?
So mixed use is defined as like multifamily retail, or mixed use as any mixed use?
I'm talking small balance under 3 million. There's no, I mean, when you get to the Fannie Freddie level and there's a 30% commercial presence to the unit, that's an acceptable, you know, environment. I'm talking about the investment that has one storefront and 2 apartments above, or 2 storefronts and 3 residential units above. There is a drawback right now in the asset-based lending space where they're basically saying, okay, listen, guys, we'll strictly do residential. We're not even allowing a concentrated commercial anymore. Let the banks figure this out. The local banks, the local credit unions, and then the investors like, wait a minute. I don't want to show my tax returns. I want to do an asset-based lending loan. Well, guess what? I mean, there's no appetite for it. Nobody wants to buy it on the secondary market, or do they want to post that loan on their balance sheet? It's really gotten very specific. I probably turn down, and I tell people, hey, listen, I have a commercial opportunity for you for that light mixed use, but I'm at 65% loan to value, 25-year AM, 5-year ARM, and probably 9.5% on the rate. Take it or leave it. And they're like, oh, I don't like that rate. Well, and go back to your bank or your local credit union. Well, they don't want to give me the loan. And I said, well, this is your option. You're going to have 35% in one way or another because it's too small for Fannie Freddie. It's not really liked by the asset-based lenders. And this is the only option I have. This is what I have for you. And 9 times out of 10, or almost 10 times out of 10, I don't hear from them again. And those properties are sitting. So my concern is, what do you do with those properties when nobody wants to buy them? And do you claim a hardship on the commercial space, and will the community let you convert it to residential? And then now you have no downtown corridors. I don't know what the big picture looks like. Do you understand what I mean?
Yeah, no, for sure. And it's so interesting because multifamily, like the larger multifamily, is really becoming almost a mixed use, especially like
Yeah.
their clubhouses, because they're turning them all into co-working spaces.
Yep.
So why would you do the same thing in a 3-unit with a retail downstairs? Turn it into a co-working space downstairs, and then lease it out to the public. That would just like kill. Because everybody wants to do the live, work, play model, and it's becoming so prevalent now in multifamily development that they even have inside the units. They're back to building the little office rooms, not a bedroom, but an office space, and not the funky desk in the kitchen, but like a true office space inside the unit. So I would totally think that would or it's not so much a nail salon, but it's almost like retail / amenity for the residents that live there. I would think that would just totally work like crazy.
Well, what I'm seeing that's getting slid through is exactly what you just said. Somebody that builds a 4-unit new construction, right? And the first floor is a commercial space. It has to be, because the zoning department won't allow it otherwise. And that the developer makes that into a co-working space for the building, and then allow it to the outside public, and they don't have to work. That's their workaround. And guess what? I'll fund that deal, knowing that it's a co-working space for the 3 units at above, and then if a couple other people rent it, it's covering its nut, and it's not that typically a big of a space. But I agree with you. The only where I'm seeing the allowability right now of mixed use presence is in the Fannie Freddie space because of the eat, work, and live environment. I was actually, I don't know if you know him. Do you know Bart Blackstone?
No.
Yeah, he's a big developer in the South Jersey corridor. He bought the Showboat down at Casino, and that hold off on the gambling license is burning off next year. He's involved with a lot of redevelopment. He is the guy that created Northern Liberties. He brought back North. There'll never be a sign or a banner for him, or they'll never recognize what he single-handedly did, but he literally brought an entire one side of Philadelphia back to the forefront. An amazing individual, and very humble and modest kind of guy. But he's now identifying an area, in the Atlantic City corridor. And he's like, listen, you need to bring lights. You need to bring people. So how do you bring lights and people? You bring food, restaurants, outdoor facilities, and apartment living. The 55 plus, or the 25 to 35 that's not married yet. And that's going to be what you want to focus on in those markets. That's going to bring back, the downtown corridors. And that's what Fannie and Freddie like. But the problem is, what do you do with the small mixed-use building that's neighboring those opportunities? Like, where's the funding going to be if the local bank or credit union just doesn't have an appetite to do that deal? I mean, you're going to have to either have more money to the deal, you're either going to have to do owner financing or some type of optionary type of environment. Like my wife is looking at a property in Bucks County where it's a former chiropractic office and an apartment above. I said, "Hun, let's go take a look at it. Let's go after it from a owner financing perspective because we know there's no financing options out there for that." And like give them the price that they want, but they're going to hold paper back. You know what I mean? Because you need to show a track record to even entertain a local bank that wants to cut. They'll cut the ribbon for the grand opening, not until though you can prove that you can facilitate managing that asset out. Right? Am I wrong?
Yeah. They'll all be at the ribbon cutting.
Yeah.
They didn't help me get there.
Yeah, they come and bring that big scissors and they cut it at the grand opening, and they're excited about their deposits that you're going to give them, and they'll give you a toaster and all that good shit. But it's all bullshit because you know what? We from a lending perspective, Amy, you and I meet all these self-proclaimed gurus. At the end of the day, if you don't have a lender in your pocket to say, yeah, this works, this doesn't work, how are you going out telling people to giving advice on acquisition without having a lender in your bullpen? Okay, because logistically, if you're not in the lending space, how can you underwrite all these deals and understand what's changing in the market? Like, I mean, you pivoted. You saw how multifamily was getting oversaturated in certain markets where you were going after. You went more toward the prop tech. Do you regret making that move? Because I mean that was a resilience move, right? That's not you saw what was happening, right? Was that a
I mean, just because I've been investing since '08. When they started raising interest rates, I was like, I see the writing on the wall. This is not hard. Like, I mean, I just kept my buildings for a little while to test out my technology. But yeah, no, I exited the market. I exited in 22. So,
yeah?
yeah.
I mean, and I saw 5, 6 years ago when I was giving money away at 1.75 to 2%. I said, this is not going to be around more than a couple of years. I better pivot. And perfect timing, Blackstone reaches out to me, brings me on board. I was there for a couple of years, then went to a correspondent, and now I'm back with who I reported to at Blackstone at Lenmark, and now I'm on full throttle. And not saying that we're recessionary proof. We're just being we follow guidelines, not regulations. That's the difference between asset-based lending and traditional lending. So we have guidelines. Now, do the guidelines change time to time? Do we bring on or take away, different type of loan products? I know we had a big discussion this week. Should we give 100% financing to the higher level investor, somebody that's very continuously submitting deals? I still don't believe in 100% financing on acquisition and construction because that means you have nothing into the deal, you have nothing to lose, and if something goes sideways, you're held with the big bag of crap. I mean, I don't know. What's your thoughts on that when you see those bad bait and switch advertisements out there?
I agree with you. I don't believe in 100% financing. I think that just that bodes poorly for any sort of performance on that asset. I think if you need to have everybody needs to have skin in the game, right? And they need to be able to be held accountable not only by their lender but by their investors too, to make sure that asset performs. I think if you have more stakeholders in the and caring about what happens with that property, the better the overall performance of the deal. Now, it's not going to say that you can't, bad things happen, bad things do. Like people get into bad assets, but I think the over leverage that we learned with this whole bridge lending thing and how people got over levered so quickly at such low interest rates, and then all those loans came due, and then they couldn't basically refi. They had to have to buy into their refis because the valuations dropped so much that if they were going to refi the loan as it was sitting, and which they were going to be forced to do, they're going to have to pay into it because they can't get a loan to match the loan amount they got back in 21. So it's really tough when you over lever, and that's because they were giving 75-80% leverage on those deals, and even at 75-80, that's sometimes too high. right? I just kind of 100% leverage. Yeah, no, I don't think that would be a good idea.
Yeah.
But I have a thing for you, Joe. So I was talking to somebody the other day, and we're talking about all this empty office space and how we repurpose it. Sometimes it's difficult to get it into housing, for sure. But what do you think of this idea? They were thinking about there's such a growing demand for data centers that doing an office conversion into a data center instead of into housing.
Well, that's not a new concept. That's been thrown around in various markets, actually during COVID as well. But my concern is how many data centers are really needed per MSA, and then how many pickleball courts can you fill up too? And that's that like it's funny. I was at my wife and I went out to a function last night where it was outdoor, and we were talking to the gentleman that was with us, and he's like, "Yeah, these guys tried opening a pickleball court down the block here, and the community shut it down because of noise." And I'm like, "Noise? Like what kind of noise can you be making with pickleball?" You know what I mean? Like what you got a bunch of John McEnroes screaming at the on the court? I missed the point. So pickleball is not as welcoming right now because now it's like we're flooding the market with it. Like we're like forcing it down everybody's throat, and you would think everybody would accept it, and it's not as accepted. Certain communities just don't want it, but they finally were able to bend the ear of the zoning board, and they got it reapproved, and they're reopening. But it was very interesting. But like I said, you're right. Like, what do you do with these white elephant buildings that you can't convert to residential? You can't do any form of conversion because the mechanicals don't work in the building. Can that support data centers, which obviously we're getting so very AI, we're going to need those. But like how many do we need? This is the interesting, has there ever been a study over the next 5 to 10 years, how many data centers will we need per market throughout the country? Does that make sense?
Yeah, I mean, no, I'm totally with you. I don't think anybody could do that study because the technology is changing so fast that like whatever they came up with, they'll probably be wrong. Like, I mean, AI is moving and creating so many different new technologies now. I mean, basically, at the end of the day, you don't have to know how to code. AI will do it for you, right? So you're going to come up with these people who have really good ideas on products or whatever it might be, and they're going to be able to get a lot of their stuff built super quickly, and which is going to increase the load of and more data is going to be needed. And so I think the data centers obviously what the biggest thing is that you need to have is cheap power. I mean, that drives where the data centers locate themselves, right? So the cheapest power sources are going to be where it's at. So I don't know if that's necessarily a Northeast region. I know in Texas we have fairly cheap power, but it's if it's not that, then it's like how do you build out renewable systems so that you can do it that way? I don't know, but it's all power based is where you locate the data centers.
So let's recap what we're talking about here and rope it in. And we got a couple of the new guests here, and we'll go back to Melissa and Justin. This is the Creative Bird Strategies house and podcast. We're the only house here on Clubhouse that has its own podcast, own website. We have educational tools for all our listeners and engaged followers. We have actually a CE course on asset-based lending that's licensed in all 50 states that can be brought to you at your association or your investors group, complimentary. So if anybody has any questions, please reach out to me off of Clubhouse and we can have that type of discussion. So what Amy and I were talking about was very high level, tying in, are we in recession versus resilience with real estate strategies? And we are in an increased chance that the U.S. will avoid a recession and achieve maybe a soft economic landing in 2024, but economic growth will slow and downside risks are elevated. Commercial real estate investment activity likely will begin to pick up a little bit in the second half, but it might look different based on what Amy and I were discussing, maybe more of a data center environment. Normalization of hybrid working arrangements will continue to limit the growth of office demand. And that's where you get a lot of these developments where you'll have a workspace instead of office retail on the first floor and you have apartments above. retail real estate fundamentals are expected to remain strong to the scarcity of new construction deliveries over the past decade. So you're going to see also mall conversions and bringing residential living to all the malls throughout I would say definitely the East Coast, east of the Mississippi. I'm sure it'll start coming on the West Coast, but there's going to be a cost factor to that and what that impact will look at. Now, some highlights here: the industrial market is expected to remain healthy with net absorption on par with 2023 levels. The biggest wave of new apartment supply in decades will temper rent growth and improve affordability for renters in 2024. We're already seeing that. That's happening right now. Interesting enough, the hotel industry is facing some serious headwinds. That doesn't mean short-term rentals are coming back to where it was 5 years ago, but because there are alternative lodging sources and there's a slower economy. So the internationally travelers are going to slow down, but I think this will benefit the domestic market. So demand for the new data center development will attract more institutional investment in 2024 as investors allocate capital from the office sector to real estate alternatives. Good morning, Justin. Welcome. Brief overview: who you are, what you do, and thoughts to our discussion this morning: recession versus resilience, real estate strategies.
Yeah, good morning, Joe. Good morning, everybody. Melissa and Amy. Yeah, I think I've been listening to the things you guys have been saying this morning. I would say a bit on point. My thoughts are kind of the same way when it comes to these other topics. But if I was just gonna keep it short and quick to my thoughts on these topics, the recession as far as the recession part, I don't necessarily like. I see how Amy says, yeah, there's a recession in the real estate market. I definitely agree to that in certain parts, but I think that maybe from the consumer side, as an investor side, right? I think we're ramping up, and usually that's how it is, right? The investors ramp up when the strictly consumers when they kind of are having the hardest time buying or making it make sense to buy. So those are just kind of my thoughts on that. And then as far as the resilience, I think, like you said, this is the time to be strategic, right? This is the time to, well, obviously you always got to have your numbers tight, but this is the time to put in place those creative strategies and say, well, look, I have a lot of cash, so I can put a good amount of cash down, pay you monthly. It's not making sense for me at a bank, right? So you working like that, or you guys mentioned a bunch of different styles of real estate / development. I think that are coming into play and that are shifting how we think and how we design and build and buy as investors. And one of the things that I was thinking about the other day, just as I come into like the end, for me, this is like the end and beginning of a new cycle. My second cycle, right? Because I got licensed in 2010, and so in 2011, and so I kind of caught the back end of the 2008 stuff, or like right in the middle of it, and then I've been around since then. So I saw the COVID stuff, and just my opinion from observing over a decade of movement is that I was taught in the beginning that real estate goes in cycles. But what I realized, it looks like to me, and some of you guys who've been around a little longer can help me with this thought, but it looks like the cycle changes. The cycle doesn't stay the same. And so what you have to do is learn to pick up on patterns, period. And I think when you pick up on patterns and learn to notice where things are going, I mean, you guys are talking about tech. Amy brought up that, you need battery power, right? You need electricity. That's the driving force. And so for me, that's a different element of looking at something, right, that I would want to put to market to yield a profit from, regardless of what it is. So I think the elements of what we have to work with and make our decisions with have changed over the past 6 years, literally, and and beyond. So I think there are a lot more variables that we have to work with. It's not just brick and mortar. It's not just proximity to downtown. It's not any of those things. it has a lot more to do with how people want to live. And you got to realize once people start moving in that direction, it's going to be a solid 30 to 50 years before we change a trend and shift that. So that's just my thoughts on it.
Justin, you touched on some good points where Amy and I were diving into. And I think what's happening is the real estate professional that wasn't part of any other economic reset is they don't have balance right now. They don't know how to pivot. They don't know how to market themselves because they don't understand the uncertainty. And fun irony to say, Amy and myself are old enough to say that we were part of the 2008 mortgage crash. We were part of the 90s unemployment issues. Okay. And we had family that were impacted by, and a lot of you don't probably even know what we're talking about, but there was a time when you had to have an even or odd license plate to get gas. There was gas issues, right? Okay, so right, my parents had to my mom and dad had to rotate even and odd driver's license plates to get gas. Now, who remembers that in the room? I bet not as many as you think. You're like, what are we talking about? So a lot of real estate professionals have nothing to compare about on understanding what's happening in front of them. And this is the problem. Everything's happening so much quicker, so much more rapid. So it's hard for them to pivot with their social media presence and who they want to surround themselves with. And funny enough, a lot of people that maybe decided not to work with somebody like myself 3, 4, 5 years ago because they were doing so well in the home buying space are now coming back, and we're having conversations with their tails between their legs and saying, "Hey, Joe, we need to have a discussion how you could help me or how we could help each other in me understanding how to identify my new client that's in front of me." And that's a very interesting perspective, and it's very humbling, and it's very, it's real. I feel privileged to be at this point in my career to be able to have those opportunities present themselves. Like, there's an opportunity for me to work with a national property management company where I met these individuals when I first moved down into the Philadelphia market 14 years ago. And yesterday, we had a deep discussion on strategy to leverage their property management presence in major MSAs throughout the country, and me being part of that. Like, how the hell did that come out of nowhere? It took 14 years. They could have worked with me 14 years ago, but it's happening now because I think the transactional real estate professional those are the individuals you want to surround yourself, not the ones that want to charge you money. I'm not a big believer in paying to play. Okay, so when there's economic uncertainties, all the Ponzi people pop their heads up. I'm talking about associating yourself with real estate professionals that they kill what they eat and they make money on completion, on transactional successes, and that's where your resilience will be, because karma is absolutely 110% real. There are compelling opportunities that are going to be emerging for real estate investors over the next 24 to 36 months. With these high interest rates and economic slowdown, the sheep will get slaughtered. The savages will burrow through this opportunity of bargain pricing for certain assets. Hybrid working arrangements are going to complement what we're doing. Amy, please, let me go back to you.
Oh, I was going to ask you, Joe. So I started investing back in 08, right? So I had the luxury of picking up some really good deals. So you and I both feel the same, that there's going to be some really cool, deals come as pricing pressure and loan maturities happen. And so there'll be foreclosures on the market. So my question was for the people in the audience is how can they best prepare themselves or if they wanted to pick up a deal, like what should they be thinking about now? Right? I mean, I had the luxury of getting into some groups and understanding who to reach out to, what kind of lenders I needed, what kind of financials I needed to have, all these different things so that I was technically kind of prepared. So as an opportunity fell in my lap, I could bounce on it. but not everybody is ready for that. I
Yeah.
don't think.
Yeah, I think you really need to understand what type of experience level you need to have in your group to identify an opportunity. So like if just say if you want to be in new construction, right? You don't have the new construction experience. Well, it's not as easy as you think just that, oh, I'll just partner with a GC on the deal to get my experience. It doesn't work that way because that GC is going to be 51% of the owner because we need to let them be the full responsibility partner in that transaction. You are going to take a passenger seat in that situation. Are you okay with that? Do you trust that GC? Really, what is their true experience with ownership? What is their true experience with third party? It's a deeper discussion with your lender, and most people don't have that discussion till it's too late and they find out they're chasing around trying to find funding for it, and then they got to go hard money because they can't go asset-based lending because they didn't communicate the information correctly. So I think understanding your power team within the operating agreement of a transaction is going to be very important. Understanding how to structure your operating agreement to complement the project is going to be very important, and understanding the funding landscape to that asset or whatever it's going to be. Like I know what I do. I focus on a very specific market more than you think. But somebody will say, "Hey, don't you know somebody that does self-storage?" Yeah, maybe, or restaurants or whatever. But that's not what I do. Like call me about what I do. Don't call me about what I don't do. But I'll get those oddball calls. Hey, Joe, do you do a warehouse? No, but why aren't you talking to the guy that does warehouse lending? Well, I really don't know anybody. Well, then you got to you got to go to industry events like Biz Now or Phil, those type of events like IMNs and stuff, and spend money instead of spending bullshit time online. Go to the real events and spend a couple grand and be in front of the people that can make those entry points and those introductions. There's nothing cheap about being in our industry, Amy. And that's, I think people think you have to be cheap and frugal. Yes, to a point, but there's also a cost benefit of attending higher level industry events that separate the savages from the sheep. Does that make sense?
Oh yeah, for sure. No, I totally get it. I think educating yourself is always the best option, right? But choosing which education you get is the most important thing, right? So going to the right events is definitely the best way to do that. Surrounding yourself with people who know a heck a lot more than you do is always a better option, right? But yes, no, I totally agree. I think I think from the people who have I don't know. I fight the people call me every once in a while and they want me to, they're interested in real estate investing. They want me to mentor them. And then my initial conversation with them is, what are your goals? Like a lot of people jump from, oh, I want to do this. And they don't even take the time to figure out what their goals are. Right. And I'm like, well, you can't figure out what you want to go do. Don't stop chasing the shiny object until you actually sit down and figure out what your goals are with what you want to do with yourself. I don't know. I think it's funny.
Well, there's a couple questions in the chat that we're gonna jump to real quick. Gentleman's asked me about the Chicago, Illinois market, and again, this is my personal opinion. Don't like again, I'm not dictating how that market is, but right now, I don't see anything positive in the Chicago, Illinois market, other than the suburbs or the migration rental reports that justify everybody's moving to Michigan and Wisconsin. So if you're talking about Chicago proper, it's a political fiasco. The mayor is kind of a joke, okay? And along with everything else he's doing is just making the city look worse. And when you have an imbalance in the geopolitical system, that impacts real estate severely. I don't see people rushing to invest into Chicago anytime soon, but the suburbs will actually benefit from such a poor government presence in Chicago. So I would be focusing in the suburbs heavily, or even Wisconsin or the surrounding states, because all the migration numbers are justifying. And then in regards to a holistic wellness farm, whatever you were asking in your chat, that's going to be totally out of your own pocket because nobody's lining up for that type of investment. And you're going to have all the money in first before anybody's going to tie in any of their lending leverage onto something unless you have a 2-year track record of success and an income and expense sheet that shows profitability. So, it's nice to have those opportunities, but most of the wellness spaces that I'm seeing is totally money out of pocket, and now you're waiting on that return on your money. I'm a big fan of holistic and health wellness opportunities. I go to, I get cryo, I do NAD shots, IV hydration. I was looking up HOCAT machines for rehabilitation. I'm looking at all types of things like that, but all that is out of pocket. The medical industry has the real estate industry and the medical industry doesn't really, well, one, they don't want the medical industry doesn't want you to be healthy. They want you to be dictated on pills. So they're also against that. And then two, the real estate industry, that's all mixed use. And then anything that comes up farm or agricultural, anything USDA, asset-based lending can't touch anyway. So if it's not true residential living, any of that stuff is kind of like, yeah, it's nice to talk about, and I love going to those type of events, but I can't fund any of that stuff, nor would I know where you would need to finance those deals as well, either way. So I hope that helps you out a little bit, but hate to put a damper on wellness, but it's a very tough market to find financing for. So Darius asked about Baltimore. Baltimore is having a really rough run, and it doesn't look any better for quite a while. And then no help to the sudden bridge collapse by a boat that couldn't find their way through a bridge. So that's a whole other discussion and conspiracy. But Baltimore is in bad shape. Homelessness, crime is rampant. Bad government policies, bad government as a whole. When you have too much of a one-sided political party running shop, that's what you get, poor results. I see the suburbs of Baltimore doing well because everybody's getting out of Baltimore. Certain areas that were really making a nice comeback are really in bad shape again. So yeah, I'd be very cautious with a market like Baltimore. I think a lot of foreclosures are looming. The city's giving properties away. So that's a scary point when they're giving them away to get investors to come in. There's a certain type of investor that takes advantage of those type of opportunities. So you got to be very concerned about that. So that's my thoughts on there. Let's see here. Associate might have 7 lots until he wants to partner. How would you structure a deal with no track record or multifamily construction? Well, if you have no track record of multifamily new construction, I wouldn't be bothering doing it because you're not going to get any funding. So that's a pretty straightforward answer, Jack. If you're going to do multifamily development, somebody in that party better be very experienced in the multifamily landscape, because right now, multifamily development versus build to rent single family townhome development there's more money in the single family townhome development than in the multifamily landscape. Nobody really wants to fund a multifamily building in my asset-based lending space. They really want to fund that they want to 7 row homes. Just imagine 7 row homes. They rather fund that than a 7-unit multifamily. Kind of weird. It's the same thing if you think about it, but they feel more comfortable because there's an exit strategy, not just for rent, but for sale on those units. So it just makes more sense. The operational structure of that acquisition, somebody that has experience in the last 48 months with new construction experience of ownership or GC third party is going to be the primary borrower. They're going to have good credit. They're going to have cash reserves, and they're going to sign on a dotted line with 51% ownership to the asset. Melissa, any thoughts from the campgrounds and fire pit?
Yeah, I got a couple. I always got some opinion, right? I loved the data center idea. I like mixed use. I've always liked that because I've worked in both commercial and residential as an office professional. So I've seen, just like you said, if you've been around a while in real estate, you have seen the ups and downs. AI. I want everybody here to take stock in their current job description. If AI can replace any of it, it will. I used to be able to walk into office management positions and be a receptionist. AI is taking those positions over. So you got to pay attention. And my last thought, Joe, as always, there's always something good to learn on Joe's morning shows. Thanks. Have a great weekend.
Thank you, Melissa. Thank you for the kind words. Yeah, I mean, listen, we're here to provide a very consistent theme of different subject matter. We're booked out, probably 2 months in advance in regards to the type of educational subjects. They're never the same. Hopefully, you walk away with a golden nugget of insight. And we could always have conversations off Clubhouse. I always follow up with anybody that reaches out to me and says, "Hey, let's have a chat." Okay, whether you get back to me or not, that's not my problem. But I always make sure I reach out to you, whether it's via email or phone call. And we're here to assist. We're here to, if there's a subject we're not touching on, and you feel maybe that it's needed, I'll review it and I'll put something together. I'll even put an article together with it. So if you're not following me on LinkedIn, I post articles on our subjects the week of every week. So tomorrow's discussion, that article was posted out yesterday. This discussion was posted out the day before. So you actually could follow up, not just on the podcast itself or the replay or our website. You can now follow up. You could follow up in regards to the article itself on LinkedIn. And I really believe you're able to really size up who you want to associate with in your business from their LinkedIn profile. Their who they are, what they do, what their why is. Okay, I feel it's very, very important. People think Facebook is the almighty guide to the profile. In this market with, understanding, recessionary issues and resilience issues, having a proper social media presence is also extremely important. Like, people need to know who you are and what you do and why. Like, somebody shouldn't call you and say, "Hey, what do you do exactly?" Okay. And this is another thing when it comes to recession or resilient versus resilience. If somebody is not working with you and it's uncomfortable, or it's I will call it painful to work with, you are allowed to let them go. You are absolutely allowed to let them go, because there's so many opportunities to work with the right people, whether it's single family rental, whether it's 2 through 4 rental, whether it's renovation, fixed to rent, fixed to flip. You don't have to work with everybody. You could have a selective mindset in your strategy and focus. You don't have to be scatterbrained. If you want to be a wholesaler, that's fine. But then if there's opportunities that you identify a really good deal, and there's so much money out there to allow yourself to be and also an investor owner, I'm seeing so many wholesalers taking advantage of the opportunities for themselves now, where you couldn't do that 10 years ago. Asset-based lending wasn't present 10 years ago. Okay. So, if you have not been to one of my courses on asset-based lending, please let me know if I can obviously have one in your market and offer the CE course, or let's break it down. You come to one of my classes. I typically teach once or twice a month. I just taught it on May 22nd this past week. It went really well. We had 25 real estate agents there. We had real estate agents that drove 2 hours to come to the class. I was very appreciative of that, and I took the time with them and went into detail to help them understand, because they know this market is changing, that they understand cycles. They've been through several. One of the individuals was laid off from a position, so they are very familiar with the shape shifting of the economy. And now he's pivoting into a whole new realm of being a real estate agent. Okay, he wants to understand where he stands. He knows it's not going to be about doing open houses and touting closings. It's about being present with active transactional professionals. Amy, any final thoughts to recession versus resilience real estate strategies?
Yeah, I would say that like Justin said, this environment provides opportunity. So if you, but you just need to be prepared for that opportunity. So prepare yourself through education. Prepare yourself with getting your ducks in a row so that Joseph can get you a loan. Prepare yourself by, starting to go ahead and identify the markets that you want to invest in. I mean, if this is really where you want to, this is where you want to go, then, tee everything up so that when our opportunities start identifying themselves, you're ready to go. I think this is a great time to do that, and we'll come out. Look, at the end of the day, the U.S. economy is very resilient. We have bumps and speed bumps along the way, but we, over time tend to perform better. Real estate is always a great vehicle for wealth generation. So it's not like you shouldn't be investing in real estate. Just be smart about it. That would be my half nickel.
Thanks, Amy. Melissa, your final thoughts to recession versus resilience.
I'm speechless. It was good stuff. Amy, I learned so much from you, and I always learn a lot from Justin. I appreciate you calling me up here, Joe. Thanks.
Thanks, Melissa. Justin, your final thoughts to recession versus resilience.
Yeah, absolutely. Just stay on your toes in this market. Look ahead to where things are going, right? And then even if they're going in that direction, like I said, stay on your toes and be ready to pivot. And I'll say this, like you mentioned, wholesale in 10 years, man. Honestly, Joe, you go back and put a date in YouTube for 2013 and type in wholesale search, you won't find many videos. It's a fairly new. It's not new skill or strategy, but as far as the trendiness of it, and even it has changed several times in one decade. So just be ready to pivot with the way the world is moving these days. And those are my thoughts this morning.
Thank you, Justin. I want to thank our sponsors this morning, Perkatech with Yordell Perkins, our social media strategist and partner at the Creative Birth Strategies podcast. I'd like to thank Realty 411, Linda Pelagas, a national publication, and also offers national events throughout the country for investors. MB Capital, your unsecured business line of credit referral partner in providing unsecured business lines of credit for investors and real estate professionals. And Lendmark Capital, your nationwide direct private lender in the asset-based lending space, residential to multifamily, new construction to renovation. This is Joe Scarice, founder and host at the Creative Birth Strategies podcast. We're here every Saturday morning, 8 a.m. Eastern Standard Time, every Sunday morning, 9:30 a.m. Eastern Standard Time, providing a consistent theme of education, strategy, and hopefully some form of networking for you to follow up and build out your power team. And my quote this morning, today is a new day. Don't let your history interfere with your destiny. Steve Marabelli. Have a great day. Be well. We'll be back here tomorrow morning, 9:30 a.m. Eastern Standard Time, and I'll be ending the room in the next 30 seconds.
Have a great Memorial Day weekend, everyone.
Yes, sir.